Good morning, good evening, or good afternoon, wherever you are in the world. The topic on the table today is explaining why you should not panic while the market is down and you are losing money.
Today's video will be broken down into 3 parts: stock market psychology and why to not worry, how to deal with a negative position, and historical stock market data. Before sharing our thoughts, I just want to share a comment from Warren Buffett. If you worry about a correction, you shouldn't be in the market. I wanted to share this because investors who begin to worry about the stock market and their positions are when equity prices begin to decline. As an investor and trader, you need to ingrain the fact that losing money is inevitable and accept that somewhere along the road, you'll lose a decent portion of your tradable income. A famous phrase when learning the ropes of investing is buy low and sell high. It seems easy enough to understand and follow, but many are unable to capitalize on it. And why is that? To simply put it, stocks are volatile, in which they rise in price but also decline. Many retail participants are not mentally prepared when their trade or investment fails and become fearful about losing money. This leads to many buying high and selling low, the opposite of what you should be doing. Therefore, you need to put your emotions aside and make rational decisions, as hard as it sounds. The moral of the story is it's near impossible to time the stock market and to always make money, unless you can tell the future. As an investor, the rule of thumb is to have an investment time horizon. This time horizon usually stretches 3 to 5 years, depending on the individual's goals.
So how do you deal with a negative position? There are 3 things every investor should consider when dealing with a negative position. Number 1, dollar cost averaging. Dollar cost averaging is an investment strategy that aims to reduce investment risk by buying in small intervals, regardless of the share price. The pros of dollar cost averaging include avoiding the bad timing of purchases and not letting your emotions affect your decision making. Since you're purchasing shares in intervals, you are consistently reinvesting money into the position, therefore reducing your cost basis as well as adding to your position size. Therefore, it could potentially make it easier to reach your break-even price as you have been buying the stock for potentially a cheaper value. Although this approach helps better manage your risk, you are less likely to experience the outsized returns as you would receive from investing all your money in the company at once, as you are instead investing in the company over time. Number 2, don't look at your positions. This tip is not for everyone, but for individuals who tend to act emotionally towards their investments and trades. Psychology makes it so you are more willing to sell out of a position when you are losing money rather than making money. It's human nature to look at others to determine the best course of action. If we see others making money by buying certain stocks, then we think it's a good time to buy, and vice versa when others are selling. And finally, get more knowledgeable about the company you're invested in while it's in its downturn. With the more research and due diligence that you conduct, the higher your conviction will potentially become. Conviction is what drives you to owning a stock and believing that the stock will potentially generate short and long-term success in the future. So therefore, when you're investing, if you struggle to act rationally when you see your position down, try to dollar cost average or avoid looking at it that day.
Historical stock market data. This is a chart of the 90-year performance of the S&P 500. What is one clear distinction you can make out? Well, it's consistently gone up despite experiencing some minor setbacks in certain years. You can make the argument that the 01 dot-com bubble, the 08 mortgage crisis, and 2020's COVID-19 market crash were all black swan events that caused immediate pain for the economy. But while these triggering events caused an economic crisis, the final outcome has been the same every time. The market recovers. What I'm trying to say again is if you're an investor with a 3 to 5 year time horizon, you shouldn't worry about any short-term price action, as more than likely the stock price of your current holdings will be much higher. Therefore, in any market correction, every investor should take advantage of discounted stock prices to add to their positions, as everyone's goal should be to hopefully reap the long-term gains in the future.
So now to the overarching conclusions. So now that we have talked about the S&P return, the psychological effects of the stock market, and how your conviction should potentially increase when stocks go down with the overall market, you should view these dips as opportunities. Going forward, make sure to, regardless of how negative the sentiment was, remember that it turned positive in the future and how it will most likely continue to do that in the far future ahead. So make sure to take this mentality with you in the market and you will most likely succeed.
Make sure to check out our Instagram page right over here where we post daily stock market picks and updates.
Make sure to check out our StockTwist Twitter and Discord, all linked in the description below, as well as hit that like button if you enjoyed the video and hit that juicy red tomato subscribe button and those post notifications also down below to keep up with our next videos. We'd also really appreciate if you left a comment below telling us if you like our financial literacy content as well as other recommendations to put out in the future. Other than that, thank you for watching and good luck on your investment journey.
Bye!